If you've got a business and you want to invest the profits from your company into property but aren't sure how, watch this video because I'm going to give you the ways to do it without paying over and above in taxes. So you've got a limited company that's cash flow generating, you've got your living expenses coming out of the business and you've got excess cash flow, excess profits, and now you want to invest them into property and build wealth on a longer term aspect. Well, the first news is fantastic. Congratulations for getting your business to this stage. And then the second of all, you've come to the right place, because what I'm going to tell you in this video is how to do it in the most tax efficient way. Get your profits, get that cash from your trading limited company into property so that you've got as much as possible to build wealth and start growing your property empire. So the first way you can look at doing this is, you've got your limited company, you're a shareholder of this, you could just take out the profits as dividends, take them out personally, pay income tax on them, and then either buy property in your own name, or you could set up another limited company, and what you're going to do is put the money in from your own name into that company as a director's loan. The advantages there, you can take it out tax-free, because director's loans, you can reclaim those, your company can repay them to you tax-free. This is probably a bad idea. The reason for this is you're going to be using up your £50,000 basic rate band. So dividends that you take out from your company, they're going to be taxed at 33%, 39% or more, which is a massive, massive tax hit. If you put out an extra 100 grand, but you're paying practically 40% on it, you're already starting off from a poor footing. It's not a good place to start. So for those reasons, we very rarely recommend this to anybody unless you've got your basic rate band available, and if you're only taking £20,000 out a year, great, okay, we'll top you up to 50, just so you preserve that, because with your basic rate band, you use it or lose it essentially. It's a very valuable, it's not tax relief, but it's a very valuable tax rate. So if you're not using your full basic rate band, I suggest to most people that you should be. So always take that 50,000 and then just put it back in as a director's loan, even to your trading business or your property business, so that when it comes to 10, 20 years time, when you do want to live an extravagant, or not extravagant, what's 50k really going to get? But if you do want to live a better quality of life, you've got a director's loan there and you can at least do it in a tax efficient way. But enough about that. So let's go on to actually some ways that might be pretty tax efficient. So the second option is going to be an intercompany loan, they call it, limited company loans. This is where you've got your limited company over here. Again, you're the shareholder. You just set up a new SPV, a new property investment company, and then you loan the money from this company over to this company. You don't really have to charge interest on it because, for one, there's no tax benefits. What you'll be doing really is just moving money from this company into this company. Both are paying tax at the same rate, most likely. However, from next year onwards, there could be a very small benefit to doing this in some circumstances. But for the most part, you're just going to be moving money around between companies and there's no tax benefit for doing so. This is a good start in that, this is tax-free. At least you've not paid 40% over to HMRC, and you've still got your full 100% of your profits available to actually invest in property. So you can buy pretty much twice as much property for your buck. However, the problem here is that over time, that loan is going to build up. So if you send 50,000 this year, 100,000 next year, it's quite possible that in 10 years time, that trading business is actually owed £1 million from your property investment SPV. And then what might happen here is, say for instance, you have any problems with creditors, somebody tries suing your trading business, you've actually got £1 million loan, which could potentially be interfered with. Insolvency practitioners, they could look to reclaim some of this loan, okay, which would mean having to sell properties and get cash to repay that loan. Or what could happen is if you look to sell that business, no one's going to want to buy that business. Hi, first of all, thank you so much for watching and supporting the YouTube channel. I really appreciate it, and I'm always looking to give back, answer questions, and help you make more money and build more wealth. if you would like some one-on-one support advice, what we're doing is if you want to talk about holding companies, group structures, investing in property, moving funds around, tax efficiencies, we're offering this with a consultation up to an hour with myself on the phone for just $499 including VAT. Click the link below if you'd like to take advantage of this. If you don't, that's cool. Keep watching the YouTube video and I hope you keep finding it useful. A business with £1 million loan to a random company sitting on a balance sheet. And then what that leaves us with, really the option here is to write that loan off, just cancel it, say it's not going to be recovered. But because they're unconnected companies, there's actually a tax charge to this. So the company that writes that loan off will have a £1 million loss. That company that benefits from that loss being written off, £1 million gain. So this company is going to get tax relief. If it's making £1 million profit, fair enough. It's going to offset that, so it won't actually pay any taxes. But your property company, that's now going to have £1 million worth of extra income tax on it. So there's going to be a disparity between getting tax relief here, being taxed here, and overall you're likely going to be out of pocket. And then there are a few more reasons as well, but they're the main ones that we tend to focus on. So as a result, it's a good start, but you just got to remember, okay, how are we going to, what's the end here? So if we keep doing this, how are we going to repay these loans? What are we going to do with the business? It's a short-term fix. So if you are looking at doing property investment from your trading business to an SPV in the short term, yeah, absolutely. There's not really a problem with loans. But as a long-term solution, it isn't a long-term solution. This is where we tend to actually say, the best long-term solution is to have a group structure. So this is where you don't personally own the shares in your trading company or your SPV. Instead, what you actually do is you insert a group structure. So basically you have a new company, and this is basically your group company, so it sits up there. And then rather than you personally owning the shares in your trading company and your SPV, you own shares in the holding company. And then your holding company actually owns shares in your trading company and your SPV and so on. And essentially what that does is, because you've got that holding company or group company, whatever you want to call it, sitting at the top, that owns all of the companies that come underneath it, that opens up a whole host of tax opportunities in that you can actually write loans off completely tax-free between group companies. You can move assets around. You can even use losses. So if your trading business has a bad year, makes £1 million loss, you can move some of that to your property business. And there's so many more benefits to this as well. The biggest one, well, I wouldn't say the biggest one, but what a big one is all about asset protection as well. Being in business and trading is risky. A lot of people think that business is safe, things can't go wrong, because a lot of the time it's easy to be oblivious. But just because you're making money today does not promise you money tomorrow. So what you want to be doing here is protecting as much of your wealth as possible. And having that group structure in place actually allows you to pay dividends from your trading business at the bottom up to your group company tax-free. And once you've done that, they are basically out of harm's way. Whereas if you leave, £250,000 accumulated your year's profit sitting in that bank, but something happens, somebody sues you, something goes wrong, essentially, which it happens in business, that money is potentially up for grabs and can be lost. So this is why having it as a dividend to that group company, and the group company, which basically is dormant for most intensive purposes, has no trading, cannot be sued because it doesn't actually do anything. There's no contracts it can really enter into and be sued upon. It can loan it down, it can invest it down, and as a result, that money is safe. So that's really the three ways that we tend to see people investing in property from their trading business. Obviously, the first one isn't very good for the reasons we stated. 2, okay, that's an all right way of doing it, but 3 really is the gold standard. Some of the downsides of 3, which the group structures, the holding structures, you've got accountancy fees. So, us accountants, we love saying go for group structures. In fact, we actually see people that, some accountants, people say, oh yeah, I want this rent to rent, I want to do this, I want to do that. And they're literally just sitting there rubbing their hands together because they're going to say, yeah, I do get 5 companies set up today. We'll get a group structure in there. Get you set up on a monthly direct debit as well for your accountancy services. And they're literally just thinking it's a payday. Whereas, that is a downside because each of these companies will need accounts. You will have to stay on top of it. So when you are starting a group company, keep it minimal. You don't want to be setting up accounts and companies all over the place. Keep it with a bare basic. So you've got your group company and then trading, investment. If that's the structure you're going for, keep it as simple as that. And other factors to be aware of, it can be a little bit more difficult to get a bank account. The high street banks don't really like, not the high street, online banks don't really like group structures, but some of the high street ones do. HSBC, Barclays tend to be okay. And then with mortgages as well, it's becoming less of a problem, but there are still some lenders that won't actually lend to property investment companies where they're owned by a group structure. So if you do fall into that category where you've got no buy-to-let experience, you don't own your own home, basically where there's only a few lenders that will actually lend to you, you might find it difficult to get a mortgage on a property where you've got a group structure in place. So that is something to be wary of, because if I say, yeah, go set this group structure up, it's going to save you tax, but you can't get a mortgage, realistically, what good is that? You're not going to pay any tax when you're not making money because you can't get a mortgage. So definitely speak to a broker to see if it will impact it. And then if it doesn't, fantastic, you're good to go. If you are looking at getting a group structure put into place, so if you've already got a trading company and you want to basically have that group structure so you can start moving the money into property, there are a couple of different ways you can do it, but for most, where your business is actually valuable, it's going to be through something called a share for share exchange. And this is basically where we have to write to HMRC, get clearance from them, and basically say that we're doing this for bona fide commercial reasons. But the end result is we basically swap shares in this new group company for shares in your existing company. End result, you own shares in group company owns shares in trading company. And then once this is done, you're free to start investing in property, setting up SPVs into the group structure, and so on. What I'd suggest doing is, if you've got any questions around this, we are offering a reduced price consultation to talk all about group structures. Any questions you've got about how they work, if you want to know how they actually get set up, basically answer any questions you've got, property investment, SPVs, best way of doing it, click the link below in the comments, and we're offering this at a reduced price for holding companies. Again, I really hope you found this video useful, so please do give it a big thumbs up and also subscribe, because my content is awesome and it's going to help you pay less in tax.